The telegram arrived at 11:47 a.m. 3 words that would echo through history: sell everything now. By noon, the New York Stock Exchange had become a war zone. Men in silk ties screamed themselves hoarse. Ticker tape machines, those mechanical harbingers of fortune, couldn't keep pace with the avalanche of sell orders. They fell behind by minutes, then hours, their clicking transformed from the rhythm of prosperity into the death rattle of an empire. October 24th, 1929, Black Thursday. But the real story, it had begun long before anyone heard the glass shatter. The intoxication, 1920 to 1929. Picture America in the Roaring Twenties as a gambler on the longest winning streak of his life. Every bet pays off, every risk becomes a reward, and with each win, the stakes grow higher. The signs were everywhere, if anyone cared to look. By 1929, ordinary people, secretaries, shoe shiners, shopkeepers, were leveraging their life savings at ratios of 10 to 1 through margin buying. You could control $1,000 worth of stock with just $100 down. The other $900? Borrowed. And why not? Stocks only went up. Everyone knew that. RCA had climbed from $85 to $420 in a single year. General Motors had tripled. The Dow Jones had surged from 63 to 381 in less than a decade. The Federal Reserve had kept interest rates dangerously low throughout the mid-1920s, flooding the system with cheap money. Banks, drunk on easy profits, stopped asking hard questions. Credit flowed like champagne at a penthouse party. But beneath the glittering surface, the foundation was crumbling. Agricultural prices had been collapsing since 1925. Factories were overproducing. Wages had stagnated while corporate profits soared, creating a consumption gap that nobody wanted to acknowledge. The wealth wasn't trickling down. It was pooling at the top like water behind a failing dam. Investment trusts, the 1920s version of hedge funds, had proliferated wildly. They existed solely to buy stocks in other trusts, creating a dizzying pyramid of paper wealth built on nothing but optimism and debt. One economist would later describe it as a thin layer of gold leaf over a substantial core of lead. By September 1929, the market had peaked, but the music was still playing, and nobody wanted to be the first to leave the dance floor. The collapse. Autumn, 1929. The cracks appeared slowly, then all at once. In early September, stock prices began to waver. Small dips, nothing alarming. The true believers bought the dips. This was just a healthy correction, they assured each other. The fundamentals were strong. September turned to October. The dips became drops. On October 18th, the market fell sharply. Margin calls went out, those terrifying demands for investors to either deposit more cash or have their positions liquidated. Many couldn't pay. October 23rd, panic selling. The Dow dropped 6.3% in a single session. Then came Thursday, October 24th. The opening bell at 10 a.m. unleashed chaos. Within minutes, 1.6 million shares changed hands, an unprecedented volume that overwhelmed the entire system. Brokers couldn't reach clients, clients couldn't reach their money. The ticker tape, that mechanical heartbeat of American capitalism, fell 2.5 hours behind. Traders were selling blind, not knowing whether they were getting $50 or $5 for their shares. At 12:30 p.m., in a scene that could have been scripted by Hollywood, a group of Wall Street's most powerful bankers gathered at 23 Wall Street, the offices of J.P. Morgan & Company. Charles Mitchell of National City Bank, Albert Wiggin of Chase, Thomas Lamont of Morgan. They pledged $240 million to stabilize the market. It worked. For 4 days. Black Monday arrived on October 28th. The Dow plummeted 13%. $30 billion in market value, equivalent to roughly $500 billion today, evaporated. Black Tuesday, October 29th, was worse. 16.4 million shares traded hands, a record that would stand for nearly 40 years. By day's end, another 12% had vanished. The ticker didn't stop printing until 7:08 p.m., more than 3 hours after the closing bell. In 2 days, the market had lost what it took 2 years to gain. But here's what made it truly catastrophic. It didn't stop. The bottom wouldn't arrive for another 3 years. By July 1932, the Dow would hit 41, a staggering 89% decline from its 1929 peak. It wouldn't recover to 1929 levels until 1954. 25 years of wealth gone. The aftermath. A nation undone. The real thriller wasn't the crash itself. It was what came after. Within weeks, businesses that had seemed invincible began to collapse. Banks, hemorrhaging deposits, called in loans that couldn't be repaid. Farmers who'd borrowed against their land lost everything. By 1933, 11,000 of America's 25,000 banks had failed, wiping out the savings of millions. Unemployment exploded from 3% to 25%, 13 million Americans out of work. In industrial cities, the numbers were worse. Toledo hit 80% unemployment. Bread lines stretched for blocks. Hoovervilles, shanty towns named bitterly after President Herbert Hoover, sprang up in parks and vacant lots. The economic contagion spread globally. European banks, heavily invested in American markets and dependent on American loans, began to fail. Austria's Kreditanstalt collapsed in 1931, triggering a cascade across the continent. Germany, still struggling under World War I reparations, descended into economic chaos that would help bring a dictator to power. International trade contracted by more than 50% as nations desperately erected tariff walls. The Smoot-Hawley Tariff Act of 1930, intended to protect American jobs, instead choked off global commerce and deepened the depression worldwide. The human cost defied statistics. Malnutrition rates spiked, infant mortality rose, suicide rates climbed, families dissolved. A generation came of age believing prosperity was a lie their parents had told. Echoes, the modern market. Fast forward to today. Do we hear echoes? Modern markets bear both similarities and critical differences to 1929. The speculative fever exists. We see it in meme stocks, cryptocurrency manias, SPACs, and the gamification of investing through apps that make trading feel like a video game. Margin debt as a percentage of GDP has at various points in recent years approached 1929 levels, but the safeguards have evolved dramatically. The Securities and Exchange Commission, created in 1934, now enforces disclosure requirements and monitors market manipulation. Circuit breakers automatically halt trading when markets fall too far, too fast. A direct lesson from 1929. The Federal Reserve has developed sophisticated tools for liquidity injection that didn't exist in 1929. The Federal Deposit Insurance Corporation protects bank deposits up to $250,000, preventing the bank runs that devastated the 1930s. The information gap has narrowed. In 1929, the ticker tape's delay meant traders operated in a fog of uncertainty. Today, high-frequency trading algorithms execute millions of trades per second based on real-time data. Whether this represents progress or simply faster ways to make the same mistakes remains debatable. Modern central banks have demonstrated willingness to intervene aggressively, as evidenced by responses to the 2008 financial crisis and the 2020 pandemic shock. The 1929 Fed maintained a hands-off approach even as the economy spiraled, a mistake that has been studied exhaustively and theoretically learned from. Yet new vulnerabilities have emerged. Algorithmic trading can amplify volatility. Global interconnection means contagion spreads faster. Derivatives markets have grown exponentially complex. The too big to fail problem concentrates systemic risk. Wealth inequality has returned to 1920s levels in many developed nations, raising questions about sustainable consumption and political stability. Perhaps most importantly, the psychological elements remain unchanged. Euphoria and panic are fundamental to human nature. The belief that this time is different is itself the recurring pattern. Every generation seems destined to learn the lesson anew. Asset prices can become disconnected from underlying value, and when reality reasserts itself, the correction is proportional to the delusion. Reflection. What 1929 teaches us. The 1929 crash wasn't a singular event, but the culmination of accumulated excesses meeting inevitable reality. It teaches us that markets are not abstract mechanisms. They are collective expressions of human judgment, vulnerable to all the flaws judgment entails. The crash revealed that complexity can mask fragility. The investment trusts, the margin schemes, the interconnected bank loans, they created the illusion of distributed risk when they had actually concentrated it. Modern markets are infinitely more complex, raising questions about whether we truly understand our own financial systems. Perhaps the deepest lesson is about time horizons. The 1920s optimists weren't entirely wrong. American capitalism did generate tremendous long-term growth, but long-term proved much longer than most could endure. The challenge facing any market participant is the gap between eventual recovery and immediate survival. The story of 1929 is neither a condemnation of markets nor a validation of cynicism. It's a case study in the consequences of collective irrationality, inadequate regulation, and the dangerous belief that prosperity can be permanently severed from productivity. History doesn't repeat, but it does rhyme. The specific instruments change, from investment trusts to mortgage-backed securities to cryptocurrency, but the underlying melody of boom and bust continues. Whether we're listening carefully enough to hear it is always the question. The ticker tape still runs, though now it's electronic. The markets still rise and fall, and somewhere, always, someone is convinced that this time is different. It never is.